Hello and welcome back to Money Talks, your guide to the world of Canadian securities. I'm your host, Rita. We received so much great feedback on our last episode about corporate financial statements. It seems a lot of you enjoyed untangling those balance sheets and income statements. A huge thank you for your comments and for tuning in. Remember, if you're enjoying the show, please take a moment to like, subscribe, and share. It really helps us out. And you can find us on Spotify, Apple Podcasts, YouTube, Amazon Music, and pretty much anywhere you get your podcasts. Today, I'm thrilled to welcome back financial professional Julia Paterson. Julia, thanks for being here again.
Always a pleasure, Rita. Thanks for having me.
So how's everything going? Especially with the roller coaster that the market has been living lately. It feels like every day there's some new headline sending things up or down.
Tell me about it. It's definitely a time for a steady hand and a long-term perspective. But that volatility is actually a great lead-in to what we're talking about today. It reminds us that behind every stock price, there's a company making big financial decisions.
Exactly, and that's what I wanted to dive into. I've been thinking about financing and listing securities lately. It sounds so formal and complex. Can you explain to me and our listeners what it's all about? Why is that so important for a corporation, and how does it all work?
Absolutely. It's a fantastic question because this is really the origin story for almost every stock you can buy. At its heart, financing is just the process governments and corporations use to raise money. They need capital, cash, to fund their operations, expand, or launch new projects.
So like a government building a new highway or a tech company developing new software?
Precisely. The government side is often done through auctions. For example, the Bank of Canada regularly auctions off government bonds. It's a very structured process where big players, called primary dealers, bid to buy this debt. But corporate financing, which is where we get IPOs, is usually a more negotiated process.
Okay, so if a company, let's call it Maple Tech, wants to raise a bunch of money, they can't just put up a shares for sale sign on their website, right? Who helps them navigate this?
That's where the investment dealer comes in. Think of them as a combination of a strategic advisor and a high-stakes real estate agent for the company's shares. Their corporate finance department does what's called due diligence, a deep dive into Maple Tech's business, its financials, its industry, and all of the risks. They have to be sure the company is a solid investment.
And based on that, they advise the company on what to sell.
Exactly. They help Maple Tech decide, should we issue debt, like bonds, or should we sell ownership stakes through equity, like common shares? Each has pros and cons. Debt is a loan that has to be repaid with interest, but it doesn't dilute ownership. Equity, on the other hand, gives you cash without a repayment schedule, but it means the existing owners now own a smaller piece of the pie.
That makes sense. It's a huge decision. So let's say Maple Tech decides to go public for the very first time and sell shares. This is the famous IPO, or initial public offering, right?
That's the one. And this is where the most important document in the whole process comes into play, the prospectus.
I've heard that term. It sounds like a university course catalog.
It's a bit denser than that. The best analogy is that a prospectus is the official, legally binding user manual and sales contract for the security. It has to provide full, true, and plain disclosure of every single material fact. That's anything that could significantly affect the stock price.
So no hiding the skeletons in the closet?
None at all. First, they file a preliminary prospectus, which has a nickname, the red herring, because it has a warning in red ink on the cover saying the details aren't final. During this waiting period, the dealer can gauge interest from potential investors. Once the regulators approve everything, they issue the final prospectus, the issue is blue-skied, and they can officially sell the shares to the public.
And how does the dealer actually sell them? Do they just hope for the best?
Well, there are two main ways. The most common in Canada for big deals is a firm commitment or a bought deal. This is where the underwriting syndicate, the group of dealers, acts as a principal. They buy the entire block of shares from Mapletech at a set price.
Wow, so they take on all the risk.
They do. It's like a bookstore buying an author's entire first print run. The bookstore is now on the hook to sell those books to the public. The other method is a best efforts agreement, where the dealer acts as an agent. It's more like a consignment shop. They'll do their best to sell the shares, but if they can't, the unsold shares go back to the company. It's less risk for the dealer, but less certainty for the company.
That's a great way to put it. So the IPO is a success, the shares are sold. What happens next to make them tradable on, say, the Toronto Stock Exchange?
That's the listing process. The company has to apply to the exchange and sign a listing agreement. This is a promise to follow all the rules, provide regular financial reports, announce major news promptly, and be transparent. The big advantage of listing is prestige, visibility, and having a ready market for your shares. The disadvantage, it's costly, and management is suddenly under a public microscope.
And I imagine the exchange wants to make sure the stock price is stable right after the IPO to avoid a huge crash.
Absolutely. The lead underwriter often performs after market stabilization. A key tool here is the green shoe option, or over-allotment option. It allows the underwriter to sell up to 15% more shares than were originally planned.
Why would they do that?
Think of it like a concert promoter with extra tickets. If demand for the stock is huge and the price is soaring, they can sell those extra shares to meet the demand. But if demand is weak and the price starts to fall below the IPO price, the underwriter can use the proceeds from that over-allotment to buy back shares in the market. This buying pressure helps support or stabilize the price.
That is incredibly clever. It's like a built-in safety net. Now, a final question on this. Can a company get kicked off an exchange if things go wrong?
Yes, they can. An exchange can temporarily halt or suspend trading if there's big news pending or if a company isn't following the rules. And in serious cases, they can be delisted permanently. This can happen if the company goes bankrupt, its shares are no longer widely held by the public, or it repeatedly fails to meet the exchange's requirements. It's the exchange's way of protecting investors.
Yurton, this has been fantastic. You've taken a really intimidating topic and made it so clear. From the underwriter acting as a strategic guide, to the prospectus being the ultimate rulebook, and the green shoe option as a price stabilizer. It's a fascinating high-stakes world.
My pleasure, Rita. It's a critical part of how our economy functions, and it's great to demystify it for people.
It really is. And with that, we've not only reached the end of our episode, but also the end of Season 1 of Money Talks, your guide to Canadian securities. We've covered everything from market players and economic principles to financial statements, and now how securities come to market. We'll be back next week to kick off Season 2, and we are going to dive even deeper. We'll be exploring fundamental and technical analysis, company analysis, the portfolio management process, mutual funds, ETFs, alternative investments, Canadian taxation, and so much more. It's going to be a packed season full of practical, powerful knowledge. So please, make sure you are subscribed so you don't miss the start of Season 2. Like this episode, share it with a friend, and join us again next week on Money Talks.